Hi class, we're going to look at declining balance or double declining depreciation here in this lesson. Double declining or declining balance, depends on the textbook you use, is another form of depreciation. As you learned before, straight line depreciation had us reduce the value of the asset equally over time. With the double declining or declining balance method, what we're going to do is we're going to take more depreciation early on in the asset's life and then later on. So it's kind of like the analogy that I had given before. Depreciation, it's like running a race. You all have the same start line, you have the same finish line, and the same time. But some runners might pace themselves evenly, as in straight line depreciation, and some runners might sprint early on, and then they wear their energy out and they have to slow down. But they still end up at the same spot at the same time. Some runners might change their pace, depending on their energy level. And that could be another method. With declining balance, we take a lot early on, and then we slow it down later on. But we still depreciate the same loss in value over the same amount of time. Okay, you're probably asking why do we do this? And that's a good question. I'm sure you asked that, right? Why we're doing that is because the principle of matching revenue with expenses. If you remember before, we try to align with accrual basis accounting. We match the revenue generated with the expenses so that we get a true net income. When we have an asset that might generate more revenue, then we're going to take more of a depreciation expense because that asset might be, it hasn't suffered wear and tear, it hasn't been worn out, it's producing more for us. So it's most likely generating more revenue. In that case, we would generate more expenses to align with that increase in revenue. Okay? So that's sort of the philosophy behind it. So here's how you calculate it. If you'll notice on the screen, I have activity 7, and it's actually the bottom of what you did previously. Okay, in my previous video, you had to do partial year depreciation. If you scroll down, we have a computer server for $10,000. Okay, and it's sorry about that. It's going to decrease to $1,000 over the course of 8 years. All right, so here's how you calculate this. Basically, you're going to need a table in order to do this. There's no quick, easy math like in straight line depreciation. What you're going to do is start off with the beginning book value of $10,000. Oops. All right. Then you have to calculate it based on a percentage. Here's how you calculate the percentage. Start off with 100, okay, as in 100%. Divide it by the number of years in the useful life. Then multiply it by 2. So again, it's 100, like 100%. Divide it by the number of years in the useful life. So in this case, divide it by 8. And then you multiply by 2. And this is why sometimes it's called double declining. So we're going to double that number. The answer we'll get is 25%. So I'm going to put in here 0.25 to signify 25%. So the first year we're going to lose 25% of the book value. So I'm going to put a formula here that says 10,000 times 25%. And there you go. So the first year we're going to lose $2,500 in value. Our accumulated depreciation will still work the same. And our ending book value is simply beginning book value minus the annual depreciation. And our ending book value comes out to $7,500. All right. Now, as you'll notice, I'm putting the beginning book value is simply last year's ending book value. So we start off year 2 with a beginning book value of $7,500. For second year, we're going to still keep the same 25%. Oops, sorry, I should 0.25%. And now we take $7,500 times 25%, and we get $18.75. Now you should be doing this on your screen. Make sure you get the same answers to ensure that you're using the same calculations. Accumulated depreciation is simply the previous accumulated depreciation plus this year's annual. And our ending book value is simply beginning book value minus the annual. Okay? All right. Year 3, last year's ending becomes this year's beginning. Okay, we're going to again put 25% depreciation. Take the beginning book value times your 25%. There you go. This year we're going to take a loss of $14.06. Our accumulated depreciation once again is the previous year's depreciation plus the current depreciation. And then finally our ending book value is our beginning book value minus this year's annual. Okay, year 4, we're going to take last year's and start off with $42.18. Again, take 25%. And our annual is taking this year's book value times 25%. Accumulated depreciation is last year's plus this year's. And our ending book value is our $42.18 minus this year's annual depreciation. Okay, let's keep going. Okay, we're going to go ahead and go to year 5. We'll take last year's. We'll take 0.25%. Look at Excel. Excel, you're so smart. Excel filled it in for us. I was going to make you guys do all the work, but Excel's making it too easy for you. And of course, we could have done formulas all the way through, but I'm purposely going line by line so that you guys can see the process. If you just simply copy and paste a formula, when it comes time to actually do this, you won't really understand what's happening. Okay? So please go through it at least the first time. Put in everything so that you know what's happening. Okay? All right, now watch what happens on year 8. I'm going to put in my 25%. Look at what Excel automatically calculated. An ending book value of $1,113. Well, at the end of 8 years, this needs to depreciate to $1,000. We're not at $1,000. We're actually a little bit too high for that yet. So what we need to do in our last year is the last year's depreciation needs to be whatever amount needs to get you to this ending salvage value. So here's how you would calculate the last year. Simply take your beginning book value minus the salvage value. That way you will get to your ending book value. And look at, these two numbers will always be the same. Whether you do straight line or double declining balance, you still depreciate $9,000. Look at, I'm going from $10,000 to $1,000. So total depreciation, total loss should be $9,000. Your ending book value should always be salvage value. It's just if you look in this column year by year, every year we depreciate less and less. So year 1 had the highest amount. Year 8 has the lowest amount. All right. This is our depreciation schedule for an 8-year depreciation using double declining balance. Again, the formula was 100 divided by 8, doubled to get this 25%. All right, let's look at our journal entry here. Let's say it's recording year 2 depreciation. We go to year 2. Go over here, see where it says annual. The annual is for the current year. Accumulated is adding up year to year, but for year 2, we have $1,875. So our journal entry is still going to be the same. Depreciation expense, probably equipment, I think is what the server should be under. Accumulated depreciation equipment, and this time it's $18.75, and that's for year 2. Okay, so that's how you do declining balance. What I'd like you to do right now for your follow-up activity is go to activity 8. You should have done this top part already. Scroll down. If you could do the computer server here, that goes from $12,000 a year to $900. Okay, we have no partial year. I'm not gonna go that far with you guys. Depreciate this asset over 4 years. Create your journal entry for year 2. Okay, then go to activity 9, and we are there. Actually, this is going to be the next thing we're going to do. So skip 9. Simply do 8, and then on your own review, there is a declining balance problem right here. Okay, so I'd like you to depreciate this asset.